auction if the PPI numbers had came in a little bit hotter than expected. But fortunately for the bond buyers, the auction, the PPIs came in a little bit softer. So let's get some context to what actually is going on in this bond world. Okay, so here's the bonds on a 5-minute chart. If we zoom out from the 5-minute chart, you can see just how bullish the bond was from what they said was a hot CPI number. And I don't think it was that hot. I mean, it was up, but it wasn't that hot. But obviously, on the basis that bonds had been rallying for a period, we obviously understand there was a bit of value there. But anyway, let's go back to the beginning of the month, because obviously that's when we start to recognize how much concession had been built into this market. And we can see that the concession into the 9th had been very, very good. And then we got the CPI numbers. Then we got the bond auction coming in at 1800 hours. Okay, so the bond auction came out for the 10s and into 1800 hours just in here. So there's the bond auction just around about this area here. So obviously we're above that auction level at the moment. We're actually above that auction just now. How much concession have we got this month? Well, at the present moment, against the previous, against the actual month open, you can actually see we haven't got any concession at all now. None. Zero. Nada. Now, that's obviously quite worrying. Except, of course, when you look at the concern we had yesterday, which is what? Well, when Sam asked the question yesterday about concessions, and what I did was I referred to the inflation break-evens chart to see how much concession we needed based on inflation break-evens. What did we find, which perhaps surprised a few people? What did we find that surprised a few people? What we found was the inflation break-evens, which if we zoom out a little bit of time so that we get a little bit more context to how inflation break-evens works, you can see inflation break-evens have been very, very hot for months and months and months, right through 2020, right through 2021. But the inflation break-evens have actually completely double backed on themselves, haven't they? They completely reversed it around. Now, why is inflation break-evens reversed round? You might be saying, but inflation is still very, very hot. Okay, so everybody gets that. I know that's what everybody sees and that's what everybody thinks. So why is inflation break-evens reversing round? When inflation is really hot, why is inflation reversing round? Hopefully you can make the connection to some of the comments I made yesterday. I said one of the most important things in trading is what? And this is the kind of thing that I know people will now be panicking about trying to answer, and therefore probably nobody will try and answer it. So I'll just tell you, otherwise I'll get pissed off again. Pricing in. The reason inflation was rising was because the Fed hadn't started moving. Understand? The reason that the inflation is rising is because technically the Fed hadn't actually started to move on rates. They were still, bonds were dropping, yields were rising, but the rates weren't rising. The rates were almost static at that stage, right? So when the Fed starts to move, the pricing has already priced in the inflation. So when rates start to move, the inflation can only go in one direction according to what we would then understand, and that is the inflation will start going up. On this chart, start going up when the Fed is now moving. That should be really, 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 really easy to understand, guys. Hopefully it is. Because it's at the core of everything we do, this idea of fundamental trading, pricing in, discounting, the whole concept that the market is a what? What is the market? A discounting function, right? The market is a discounting auction. It discounts everything. That's the point of it. It prices everything in. So obviously if the yield is here, or inflation is here, and the Fed is here, and inflation starts to do that, and the long-term bond yields start to do that, okay, so the long-term bond yields start to do that, and the Fed is still doing that, well, that's called a steepener, isn't it? That's called a steepener. That's what we see, a steepening curve. But as soon as the Fed starts to reach a point of, well, we better not let this go any further. We're behind the curve. We don't know what we're going to be doing. At that stage, the Fed move. And as soon as the Fed moves, the inflation stops moving, or potentially starts dropping. It starts squeezing. So a lot of people don't understand this, but it's all about what's been priced in. It's not about what is the data. The fundamental outcome from a data release is irrelevant in some respects. It's about what's been priced into that information, right? That's all that's important. That's why good news can sometimes result in a stock dropping, and why bad news can sometimes result in a stock rising, because the good news is against the forecast, but the market's already priced in the forecast plus a little bit of extra. So when the good news comes out and everybody who doesn't know anything starts buying the stock at ridiculously high prices, it's already been in the markets, guys. It's going to go down. So when you buy it, it's immediately sold by the big boys to close out the positions. It's priced in. So this is priced in. So when the Fed starts moving, the inflation break-evens rise. As in a positive correlation to bonds. Actually, that's inflation break-evens falling, of course, because it's a positive correlation. Does everybody understand this? I'm still thinking that a lot of people don't quite get this yet. Or it's maybe that they don't know, it's not that they don't get it, it's just that they simply don't kind of get their heads around this concept. If the market's really bullish and really bullish comes out, the market's got nowhere to go. If the market's really bullish, it's already probably gone up, right? If the market's really bullish, it must go up because everybody's priced it. Everybody's done it. So this change in the inflation break-evens here is obviously when the Fed is starting to show up as a possible play now. It's starting to show up as a possible play. And obviously when we start to recognize the possible play, we can start to recognize what's going to happen next. Now, how do we see that? Well, let's just stop a second and just think about that as a storyline. Now, you could obviously look at things like, say, 3-month yields. You know, if you looked at 3-month yields, you could start to analyze 3-month yields on this. You could start looking at the Fed funds rate to see when the Fed funds rate starts moving. And all of these kind of lovely things start to kick off, right? All these easy to see elements kick off into this channel. But obviously it's up to you about what it is that you want to be recognizing on your screens. It might have too many things, and therefore as a result, all you have to do is make sure you remember what's going on, guys. That's it. So with inflation break-evens, this is already priced in. So how much more of a discount do we have to price in the Fed? Well, we still have to keep pricing it in, but remember, the 30-year yield's already priced in quite a lot of interest rate moves, haven't it? It's not as if it's sitting at 0.5%. The 30-year yield is nowhere near 0.5% or even 100 basis points. Look for yourself, guys. The 30-year yield is nowhere near that, right? So in other words, if the Fed's neutral rate, which is the 2-year rate, okay, so let's just take a look at this. So the Fed's neutral rate is usually about the 2-year yield, going forward, which is the neutral rate. So when we start looking at this, the 30-year yield's already priced in 3.3%. That's huge, right? So what's the neutral rate? What is actually the neutral rate? Let's go and put this in as the US 2-year yield. So we'll call the US 2-year yield the neutral rate. Let's scale it the same so that we've got the neutral rate on the scales. So look at the difference. In the early days here, the 30-year yield, now bearing in mind that the 2-year yield represents what you'll hear a lot of it. It's not actually true, but it's pretty close to true. It's close enough to truth. That the neutral rate is basically not the short-term movement of rates, but where it kind of plateaus after 2 years, right? They don't really take any more views, because they can't take any more views than 2 years out, because they don't know what effect the rates are going to have, right? So when I hear the Fed talking about the neutral rate, I'm kind of led to what they believe the 2-year is going to be doing. So when we see the 2-year, and this is now scaled properly, okay, so you can see the 2-year has never been, well, it's down into that bottom bracket, right? So the 2-year is only 2 years away from the Fed funds futures, right? So the neutral rate's up here. Well, you can see that the difference between the neutral rate and the 30-year rate is almost zero now. They've almost achieved what they wanted to achieve. Now, they've not moved the rates to that yet, and they might, if the 30-year takes off again, they might have to move, but the difference between these is what the problem is for the Fed, right? So the difference there is so huge that the Fed has to start thinking about the probability of raising rates. And you can see what happens to the 30-year when they start raising rates, for example, here in the 2-year complex. You can see that there is a almost immediate sell-side reaction on 30-year yields. 30-year yields representing perhaps long-run inflation. So this seems to make an awful lot of sense now, doesn't it? This idea of steepenings and flattenings. When the rates are falling and static and inflation is coming in, then of course we get this incredible steepener. Now when we see this as a 5-year inflation break-even, so that would obviously be something like, because this is yields we're looking at, this would be TIPX divided by the ZF. So this is now the 5-year inflation break-evens. This is what happens to the 5-year inflation break-evens. Now obviously these are inflation, so this should be closer to the 30-year yield, shouldn't it? It should be closer to the 30-year yield. So when it's closer to the 30-year yield, you can see what happens when we see this big ramp up here on the 2s, right? When we see this big ramp up in the 2s, inflation break-evens actually go down, not up. That seems to make an awful lot of sense now, doesn't it? You can see the big ramp up that we had on yields here. Inflation break-evens actually went sideways to down during that period. Because the whole point about raising interest rates is what? What is the point about raising interest rates? To try and control inflation. So if the inflation break-evens kept rising, the Fed has to keep going to try and get it under control. So what happened here? Well, inflation break-evens kicked off. Remember, that was the big move on. Well, let's take a look at what that was. Let's take a look before we preempt what it is. Let's take a look at, for example, on oil prices. Does everybody see that the big ramp up in inflation break-evens was on the back of the big ramp up in oil prices? Yes or no? So we got this big ramp up in oil prices. We got this big ramp up in oil prices here, energy prices, and that brought the inflation massively back into the upside, right? And what was the cause, like Sam's just mentioned, what was the cause of the oil prices ramping up? Well, it depends where you go back to, because oil prices started to ramp up in December 2021. So the December 2021 ramp up in oil prices obviously wasn't Ukraine, but this last big spike here was obviously the Ukraine narrative, right? It was obviously the Ukraine narrative. So there's obviously problems in the background to this whole system. But you can start to understand it now. The inflation break-evens and oil prices are very slow, are very, very positive correlated markets. Of course they are, but they're not 100% correlated. Yeah, we've got gas, we've got food prices, we've got all these other extra prices to add into this. But we can start to understand just the logic of the markets, can't we? The 2-year ramp up here is because the Fed is now on the move. You might be saying, but the Fed never moved in November. Doesn't matter. The market believes the Fed is going to be moving over the next 2 years because this is 2-year yields. Understand? Because this is 2-year yields, it's not whether the Fed's moving today, it's how much they believe the Fed will be moving in 2 years' time from today's date. That's why it's a 2-year yield. So when we look at the Fed, and obviously the Fed is just going to be 100 minus ZQ, of course. And you can see that ZQ is the 30-day Fed funds futures. When we do 100 minus ZQ, we can see that the Fed has only just started to move now, hasn't it? So the 2-year leads the Fed. And what happened when the Fed started to move here, and then when the Fed moved here, and when the Fed moved here? Well, on this first kind of move here, on this first little move here, and then it went sideways for a few months, when we're getting ready for this big move here, that's when the inflation break-evens dropped. It's exactly when the inflation break-evens dropped, didn't it? So we start to understand the concept of macro fundamentals, interest rate rises, and the fact that the Fed funds movement higher is already in the marketplace. It's already priced in, guys. So the idea of concessions is very, very, very relevant. If we've got a gap between the 2s and the 30s, the bigger the gap, the more relevance there is, because obviously that is starting to become very, very exciting for bond traders, because there's maybe no more further rates on the long-term bonds to go. There's maybe nowhere further to go for the 30-year bond traders, right? So this is maybe the lows. It's already in the markets, right? It's already priced in. Now, things can change. We can get rampant inflation, hyperinflation. Of course, anybody that bought the bonds at a 3% yield are going to be kind of pissed off, right? They'll start selling all of those bonds, and when they sell all of those bonds, the yield on the 30 goes up to 5%, 6%, 7%. But the point is that the yield on the 30 is nowhere near those levels. The yield on the 30 is way, way, way down. The yield on the 30 is only at 3.2%, dropping recently back down to 3% itself. So when we think about this, we think about a storyline on yields. We think about a storyline on yields. Well, there is actually another way of looking at absolutes, Miguel, and this is why this is one of the things we do when we build out the absolutes curve. Because remember, the absolutes that we show on the screens isn't the absolutes. The absolutes that we show on the screens is the curve of the absolutes, right? How the curve is changing. But if I wanted to show the absolutes on the screen, there's obviously lots of different ones, and the closest we can get in the trading view screens to an absolute is just to do, for example, US 30-year yields plus US 2-year yields. And that shows an absolute yield now, doesn't it? So in other words, if I swap the 2s for the 30s, or if I swap the 30s for the 2s, we'd start to understand the difference between that yield, wouldn't we? If I swapped one for the other, we'd start to recognize exactly what's going on, right? In other words, if we swapped a long-term interest rate for a short-term interest rate, we can start to see this. Now, obviously, you might say, but this is going to be incredibly positively correlated. Well, let's take a look and see what it actually is. We'll not scale this one. Why is that going up? Well, because we didn't scale that either. We'll take that scale off as well. Okay, why is the scaling all wrong, guys? I need to change it here, don't I? Idiots. So you can see the absolutes. Now, why is this absolute yield important as well? Because obviously if the 2-year goes up really, really fast and it causes a big sell-off in the 30-year yield, the absolute becomes zero, doesn't it? The absolute itself becomes zero. So if the 30-year yield is at 5%, So if we think about it, if the 30-year yield is at 5% and the 2-year yield is at 0%, and the 0% 2-year yield goes up to 2.5%, and the 30-year yield goes down to 2.5%, the absolute's now 0. The loss on the 30-year is exactly the same as the gain on the 2.5-year, the 2-year, right? And that creates a 0 point for the absolutes. So we can start to recognize this absolute storyline in the background here. Now it just looks like 30-year yield. That's because most of the movement is in the 30-year yield itself. We start to pay attention to that as a story. Hold on a second.